Good morning, listeners, and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. As we keep saying, financial markets work on narratives. The data released on Friday indicated a cooling wage inflation, which supports the market's narrative of a slower rate hike by Fed. However, the jobs data came out stronger than expected and unemployment rate went down. This led to a strong rally in stocks and currencies across the board, strengthened against the dollar. JK, I would like to know your thoughts on the data released on Friday. How are you reading it?
Yeah, good morning, Swaraj. Actually, once a while, Quizmaster comes out with a question saying this one for all, and it was a similar market on Friday. And with successive weak reports from US on wage inflation, services contraction, lower factory orders, and some Fed speakers even sounding less hawkish than earlier, encouraging reports from Europe of lower inflation and higher retail sales, and a ripping jobs report from Canada would have left no doubt in anyone's mind what call to take. So what followed these reports was bereft of any surprise. Over 2% gain for equities across a sizable rally in bonds, yields falling rather, and currency slicing through resistances with ease, and the dollar ending the week with a loss of over 1.5% and erasing all of its previous gains. Headline report on jobs, as you said, was better with 223,000 gains versus 200 expected. And the unemployment rate at multi-year low of 3.5%. But the surprise came from wage inflation with a downward revision to previous month even. If you remember, previous month, the wage inflation month on month had doubled, and that led to rally in the yields, fall in stocks, and a rise in the dollar as well. But this month, it has revised down from 0.6 to 0.4. And this month itself, it has come from 0.4 to 0.3. So there was a very encouraging sign. Then ISM services report was the biggest surprise, falling to a contraction territory first time since May 2020 at 49.6 versus 56.5 last month and 55 expected by analysts. And the details were no better. Employment side sliding to 49.8 from 51.5. New orders plummeted to 45.2 from 56. And more importantly, the price paid component was at 67.6 from 70. So another sign of inflation easing in the economy. Factory orders were lower as well in the US, and another sign of economy cooling off. Canadian labor market ended the year with a strong note as the economy added a whopping 104,000 jobs in December, showing no signs of a slowdown, which economists have been anticipating. Unemployment rate fell slightly to 5%, and this marks a third decline in the unemployment rate in 4 months. So, with the evidence of economy strengthening, forecasts of another 0.25 increase in the policy rate by Bank of Canada have again mounted. So with the fresh risk capital for the year, it was no holds barred for action from the traders in the risk assets. Wall Street's main indices all gained more than 2%, and the wage increases, slowing, encouraged the expectation that Fed will be on a lower hiking path. The MSCI All World Index leapt 2.1% rather. The sharp bounce in stocks after remaining subdued for long bodes well for further gains, considering the background of the economic news. Although we will still want to see CPI report later this week, as also the earnings report from companies in the coming days. The short-term yields jumped, particularly the 2-year fell almost 16 basis points, and on expectation that Fed might push its overnight benchmark rate at much lower pace. Moves reversed the previous day's bond market sell-off, which came, even as the job growth and unemployment rate for December were better than expected. Obviously, the key was a drop in wage inflation. So the expectation of peak rate is now certainly at 5%, down from 5.06 just for the data. Also, the traders remain split about the size of February move, which is now suggesting 25 basis points mostly, and more likely than 50. Longer dated contracts actually anticipate a rate cut by the year end. Just German yields also fell, by 13 basis points in the 10-year tenor. Bostic and Workin, the Fed members, made slightly less hawkish statements, hinting at caution over the slowdown ahead. Dollar's recovery in the week before US data just got halted in its tracks, and the greenback was sold across the board in US session. US investors getting more confident that Fed terminal rates will be lower And the major gains came for yen moving from 134.77 to 131.98. Now it is pushing towards 131 figure as well. Euro rising from 1.048 to 1.0670 just now. And Canadian dollar followed with a hefty gain after strong jobs report. The Chinese yuan, which has been outperforming others with the prospects of its economy bouncing, improving after COVID restrictions easing, further strengthened to 6.8175. Now currently it trades below 6.80. The yuan has recouped more than 50% of its losses suffered since last year from 6.30. Gold rallied more than 2% on Friday with a weekly gain of 2.5% with the help from lower yields from US and Europe. Now the dollar index is holding about December low of 1.0344, but the support can come under threat later if the CPI number comes weaker, and the next strong support comes at 102 and 100 psychological levels. As for the rupee, will the recent history of buying into overseas induced dip repeat itself? That's the big question on everybody's mind. But what factors can actually be different for the rupee is that the USD INR has been rising for almost 13 months in a row now. Importers are better covered, and exporters have been covered much less than they are usually used to. And also, the rupee might be getting slightly undervalued with the other currencies. Oil prices are staying at lower levels for much longer now, which may be a sign that trade balance can get better. So all in all, for a currency which has been moving one way for long and has had no time correction as well, can see a breakdown, but it needs a break. It needs to stay below 82.40 on a daily closing basis to encourage shorts. Upside resistance will be there at 82.60, and going above that would again keep it in the recent ranges. Finally, on the encouraging side, Ministry of Statistics in India has indicated that growth will touch 7% in 2023. Slightly higher than what RBI projected in their forecast at 6.8%. The report indicates laggard sectors picking up and investments also picking up. Finally, slightly not so encouraging news, like the global financial institutions have been warning about the global economy. World Bank says further adverse shocks could push global economy into recession in 2023. IMF managing director is saying with a warning that the world faces a tough year, tougher than the year that we have left behind. 1/3 of the global economy can be in recession because of the US, and the EU and China are all slowing down simultaneously. So that's a note. Of course, I think investors and traders start the second week of the trading on a upbeat mood, and possibly CPI will add to their mood. Thank you.
Thank you, JK. Those were some action-packed updates. And just to summarize, we saw a weak report from the US as we observed some contraction in their economy. We observed some Fed members being dovish. This led to, of course, stocks rallying, while this also led to the peak rate expectations to come down to 5%, while also 25 basis hike is being priced in with higher probability for the next Fed meeting. We saw Chinese yuan strengthen further as the economy opens up, and a broad-based strength against the dollar in major currency pairs. We need to see the CPI report later this week. That's it for today, folks. Number can change stories very fast and bring in volatility. Bring certainty to your cash flows by managing risk. Thank you so much for listening.